What is market capitalization? As decided by the stock market, the firm's value is known as market capitalization. It's the sum of all outstanding shares' market values. To find a company's market capitalizations, multiply the number of outstanding shares by the current market value of one share. Corporations are divided into three groups based on their market capitalization: large cap, mid cap, and small cap. In today's video, we show you everything about market capitalization. So without further ado, let's begin. Knowing how to calculate market capitalization. Market capitalizations is a quick and straightforward way for publicly listed firms to estimate their value. In this case, just multiply the share price by the number of available shares. For example, a business with 20 million shares that sells for $100 each has a market cap of $2 billion. On the other hand, a corporation with a $1,000 share price but only 10,000 shares outstanding would have a market valuation of $10 million. Market capitalization calculations is done by multiplying the share price by the total number of outstanding shares. Strategy for capitalizations and investment. Large cap corporations do not necessarily deliver significant returns in a short period. Still, they frequently reward investors with consistent gains in share value and dividend payments over time. Companies with a market value of $50 million to $300 million are considered microcaps. Market caps misconceptions. The market does not measure the equity value of a company. It measures the cost of buying all of its shares. It is inadequate to value a company because the market price does not necessarily reflect how much a piece of the business is worth. Shares are often over or undervalued by the market, which determines only how much the market is willing to pay for them. The market capitalization fluctuates. Significant fluctuations in the price of a stock and when a corporation issues or repurchases shares can affect a company's market value. Dilution occurs when an investor exercises a significant number of warrants, resulting in a rise in the number of shares on the market and negative impact on shareholders. Is it beneficial to have a large market capitalization? Having a high market capitalization has both benefits and downsides. On the other hand, larger corporations may be able to obtain better financing agreements from banks and sell corporate bonds. But on the other hand, these businesses may also benefit from size-related competitive advantages like economies of scale or extensive brand awareness. On the other hand, large organizations may have limited options for further expansions, and as a result, their growth rates may be slow over time. Market capitalizations is the sum of all outstanding shares' market values. For example, a business with 20 million shares that sells for $100 each has a market cap of $2 billion. Large cap companies generally rewards investors with a consistent increase in share value and dividend payments. The market does not measure the equity value of a company. It measures the cost of buying all its shares. Shares are often over or undervalued by the market, which determines only how much the market is willing to pay for them. Having a high market capitalization has both benefits and downsides. So, this is all about the video. Let us know your views in the comments below.